Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LevFin Insights Levered Line Podcast. I'm Steve Miller, a member of the CreditSights team here at Fitch Solutions. Today, we're talking with Jonathan Insull, Chief Investment Officer of Nassau Global Credit, about developing the next generation of loan market talent. It's a topic no one is more qualified to speak to. Jonathan is a market veteran and CLO pioneer who began his career at Chase Manhattan Bank back in the day before moving to the buy side in the mid-90s. After a 25-year run at TCW and its successor firm, Crescent Capital, Jonathan joined Nassau in 2022. Through the years, Jonathan has been a great friend of the family here at Fitch and a consistent and upbeat partner at golf. Jonathan, thanks for joining us today.
Oh, thanks, Steve. It's great to be here. Thanks for having me in.
Appreciate it. So as a table setter, let's start by asking you to tell us about your career path and your current role at Nassau.
Sure. So you touched on it. It was really very kind of the traditional route in through credit training program at a bank. And at that time, the banks were willing to invest significantly in the trainees, bringing them in for a 3-month training program.
Wow.
And they brought in professors from some of the leading universities here in the city to teach us things like accounting and financial statement analysis, things of that nature. So from there to a line assignment originating loans, this was back before loans were syndicated.
Yes.
So it was more the originate to hold model rather than to distribute. That was sort of the beginning of the originate to distribute model in the loan market, and did kind of 5 years on the new business side, and then in what turned out to be a pivotal experience for me, 5 years on the restructuring and workout side. So I spent a significant amount of time working on bankruptcies, everything from small middle market loans. I was fortunate to have the individual who ran that group at the time believe that you should do a little bit of everything. So you might get a loan to a middle market company, garment manufacturer, for example, and then you might get a broadly syndicated loan to a telecommunications company to work on, where the bank was agent for a large syndicate of lenders. I spent 5 years doing that, got to work with some very, very smart people, particularly bankruptcy attorneys and other restructuring professionals. And then had an opportunity to go over to the buy side and was really feeling like I wanted to kind of take the show on the road. I had been at the bank for 10 years and acquired what I thought was a good skill set. I said, let me go try and apply it in a little bit different way. So went over to what was then Crescent Capital Group, to a small team. There were just really 3 of us. And this was back when bank loans were quite the backwater of the financial market, and early days of CLOs and securitization of syndicated loans. So I felt like I was somewhat fortunate to be able to get in relatively early.
Yes.
And from that, sort of built on and had a variety of different experiences on the buy side, but really mostly focused on credit, securitization, but kind of did a little bit of everything, and building the business as well. To be able to raise money, manage the money, and run a business are kind of the 3 things that you need to learn how to do, I think, for a longer term success in the industry.
Sure. And if my memory serves, you had first joined Crescent when it was a small independent operator, then it became part of TCW, and then somehow you guys spun back out, right?
Yeah, I came in when Crescent had recently become part of TCW. So we were just in the early days of what would be roughly a 15-year relationship with TCW. And we were, again, just really kind of a small part of the business, before we saw the growth. And this was back in the days when memories of, the junk bond crisis and all of that were still relatively fresh in people's minds. So we were certainly viewed with some suspicion, back at that time. But, over time, gained traction and were able to grow the business in different ways. And, now credit is, a market that, frankly, I think gets, a tremendous amount of attention within the industry in ways that it didn't, back in those days.
For sure. And then just a little on your current role at Nassau.
Sure. So at Nassau, I serve as Chief Investment Officer of our global credit business. We manage below investment grade corporate credit in the United States, in Europe, in a variety of different formats, including in securitization vehicles. So we issue CLOs in the United States and in Europe. We also invest in loans and high yield bonds through other types of vehicles, limited partnerships. We also invest in debt tranches issued by other CLO managers. So I serve as Chief Investment Officer of that part of the asset management business.
Very helpful. Thanks. So now I remember back in the day, people would be very proud of the fact and it would be a badge of honor to be credit trained at one of the big banks like you were. How do you compare that sort of career trajectory to what people are experiencing today who aspire to long-term careers on the buy side?
I think it's definitely changed. It certainly changed even back when I was at the bank, and as kind of that profitability model came under pressure, the balance sheet model came under pressure. More of a desire to be an investment bank, basically, back in the days when there was this bright distinction between investment and commercial banking. And I think that the training programs have changed over time to, where they are more, kind of focused on that, kind of investment banking approach, originate to distribute, a little bit less of a principal mentality. So I'm not saying that it's worse,
Right.
but it's different. It's different. The people who you meet today that have come through those programs are certainly extremely bright, extremely knowledgeable, very market savvy, certainly well-rounded. They still do offer, we recently made a hire, an individual junior analyst who had rotated through various parts of a large financial institution, a global bank, and came in very well-rounded. But it's a little bit different from, the very focused, kind of corporate lending model that I went through. So I think that presents, some good things, and but also some challenges that I think when people do land on the buy side, need to kind of be addressed. And as you look to recruit out of banks, which, let's face it, that's what a lot of people on the buy side look to do.
Sure.
Right, is to recruit from the banks. So you just need to be aware as those people are coming in that, their background is different from your own. Their training's been different from what you received.
And if you drill down on the positives and maybe some of the less positive aspects of today versus the past, how would you scale that?
I would say that, the positives are extremely market savvy and, sort of capital markets aware, maybe more so than we were as credit analysts coming out. Again, because they've had exposure to sort of the broader liquid capital market. So I think that the discipline that they bring, because of the training that they've had as investment bankers, is also very helpful. I mean, these people can put together PowerPoint slides, like their lives depended on it. So I think that's good. The ability to work quickly. But again, I think the attention span, I mean, for those of us that have been in the loan market, you acquire these assets, you expect you're going to have that on the balance sheet for a long time. This isn't like, okay, we got the deal done,
Yes.
move on to the next one. You're going to live with this thing. You're going to live with this. So I think you have to, understand that I guess the horizon is different. The investment horizon is different. And so you just have to calibrate around that, I think.
That's interesting. So you think about the skills that people should want to acquire, educational skills, technical skills to make that transition to the buy side and set them up for success. How would you describe those?
Well, I think, in the first instance, the market has become, and you've been one of the people, frankly, who helped it get to this stage. I guess you're, a contributing actor here, but so data driven,
Yes.
so data driven. So anything that enables a person to quickly obtain data, analyze the data, and then to present the data. So some of that is clearly software. The ability to use, whether it's database software, to be able to do research, in a way that's quick. Part of the problem is, sometimes just too much data, right?
Right.
So ferret out, the signal from the noise,
Yes.
distill it, and present it to others in a way that's understandable, right? Explaining is kind of the secret sauce too. So I think anything along those lines, and there are just so many tools available. Obviously, AI is starting to make inroads into the market. I know that's something you and I have talked about a lot. But at the same time, it's also important, I think, to be able to take a step back, to understand the story behind the data, to understand some of not just the what, but the why. And to, why is it the way? Here's the way it is. Well, why is it that way?
Right.
I think, communication skills, particularly learning to communicate, in real time, and avoiding an over-reliance on email. The tendency, I think, for people coming into the business, to think that sending an email is the same as doing work.
Right.
I don't know at what point in the country that became like, I did work because I sent email. That's not the same, and being able to actually do it. Lewis didn't send Clark an email.
Right. Right.
Hey, we should go to the ocean. Okay, yeah, maybe we should. Well, I sent him an email. You have to do it, right? And so being able to get sort of your hands on so many more tools available, which is exciting. But learning to be able to kind of do the job, when maybe the perfect tool isn't available, or to understand why you're using that tool to do that job. I think that's important. But there's no way you can deny that, that the data is so important, and what drives it, and finding ways to get that data efficiently. It's so many tools available, just, figuring out the right one to use for the job.
When you guys look at hiring, it used to be when we were young, the table stakes where you had to be a black belt at, I guess, Lotus 1, 2, 3 at one point, and then we moved to Excel, which was a painful but a very rewarding process. Are there table stakes like that now outside of spreadsheets that you look for?
Yes. So we recently went through a hiring process, and once we kind of got through some of the more social aspects of the of that process, of that search, the case study
Yes.
was very key. So a little bit of a artificial environment, but having somebody come in, be handed a credit, and be able to, in theory, one they've not seen before, but hand them a credit and have them be able to do that research, using in a sort of closed environment with resources that we provide, and to come up with an analysis and a recommendation, all within a few hours.
Interesting.
So that's not the way that we underwrite, generally speaking, but for purposes of trying to compare and contrast candidates, and to evaluate them. And clearly, it's not so much in that situation the recommendation, but tell us how you got there, right?
Yes.
The steps that you
Yes.
took to get there. To me, always an important question there is, if you had 4 more hours, what would you have asked? Or if you were sitting with the company's CFO or with the private equity sponsor, what questions would you ask them? To us, those are, sort of the critical things to be able to come to a conclusion and to present it along with sort of the thought process, show your work as
Yes.
opposed to buy, sell, because, certainly in the credit market and certainly in a large and complex organization, which most asset managers have increasingly become, you need to be able to communicate and present.
Interesting. So just taking a step back here, let's talk a little bit about the broader context. So when we were young, the market was just on the precipice of growing and then had this explosive growth. So all of us who were lucky enough to get in when we did in the late 80s or early 90s got to ride that wave. Given where we are today, are you still bullish on the business as a career model for young folks?
I think so. I think that, it's a couple things that you have to, though, keep in mind. Number one, you have to realize kind of what's going on and understand that it's, a lot of it is about fit.
Mm.
So if you think about, I know you're a baseball fan.
Yes, indeed.
So what does a baseball player thinks? Well, I can't believe I get paid to do this thing.
All right.
That's so much fun, right? Well, it's a little bit like that here, right? In our industry, right? You're basically getting paid to do math and economics.
Mm-hmm.
So if you like math and you like economics, it's probably a good gig because you're going to get paid to do things that you like. If you like taking a problem and trying to simplify it and take it apart, be a bit of a problem solver, probably good. And you'll get paid to do those things. If those are things that, don't really suit you, I think what's sad is when young people try to force themselves into the industry because of the compensation.
Yes.
And so that's really unfortunate. It's not going to be a good experience for that individual, and it's probably not going to be a good experience for that individual's employers who, then are sort of struggling to figure out, what's going on with this person. So it doesn't necessarily have to be something that you love or your passion. Your passion could be, playing the violin or whatever the case may be, go and do that, on the weekend. But, this should be something that you enjoy and that you're good at. I think it can be an excellent career for people that are like that. I do think you have to manage expectations. The business over the years has become much more competitive, intensely competitive. Fee compression, that's put pressure on revenue line and put pressure on compensation and the bottom line. So it's a much more, I feel like, the idea that I can, come in and make a lot of money and, kind of not work very hard and all of that, that's a misperception. I think some people unfortunately come into it with unrealistic expectations. But if you come into it with the right set of expectations, then I think it can be an extremely rewarding career, especially for somebody that's inclined towards, towards some of those disciplines or some of that subject matter.
Well, that's good to hear. So you're still bullish on the opportunity and the growth out there.
Very, very, very much so. Very much so. It's a great opportunity for people that, kind of want to be doing it.
So when we played golf a month or so ago, you mentioned that you're spending more of your time mentoring young people. It'd be great to drill down on that, how you're going about bringing those folks along.
Yeah. So that's something that I think is extremely important. I think it's something that, unfortunately, the industry, financial services generally, and maybe asset management in particular, hasn't always gotten the highest marks on. It's chronically, I think, been criticized as an industry that's sort of undermanaged, and I think I think there's some truth to that, and that's unfortunate. I think there's a tendency in the industry, um, and this is probably true in other things as well, but, you take your best doers and
Yes.
you promote them, up the chain, and that's not necessarily the best person to be managing, teaching, coaching the next generation. So, I think that's probably an area, generally speaking, that, that the industry could do a little bit better, kind of that, professional development, which sounds very corporate, but that's really what it is. I think a couple things, there's, um, I guess it's a kind of a truism in management. You get the behavior you pay for.
Mm,
And that's true, but I feel like maybe a better way to think about it might be, well, you get the behavior that you model. So I
right.
guess to answer your question, one of the first things is just to kind of model good behavior.
Sure.
And especially people that have come into the workplace in the last half a dozen years where they were COVID impacted in the
Mm,
early years of their career. And so they maybe, because of remote work, didn't necessarily get exposed to, sort of models of behavior. And so I think that's a big part of it. I think explaining,
mm.
which is hard. You have to be patient,
Yes.
and certainly, recognizing, and I get frustrated with this, just ask my wife, but the journey is the destination,
Yes.
sometimes
Yes.
not just the destination, is the destination. So taking a minute, to explain, kind of the why, I think helping understand, and this is where it's helpful, I think, for people to be around, those are sort of a little bit more seasoned, is, sort of the history, the why, again, kind of that why we do, why is this way, the history of the business. And I think one of the nice things about corporate credit below investment grade is it's a relatively young market,
For sure.
going back, certainly to the 1980s, right? Others would point out that it goes back much further than that, but still it's a relatively young market. And that's kind of, fun. I mean, you and I have been around since the early days,
For sure. Yeah.
and there was no index
Yeah.
when there was no. So it's not really that difficult to take a younger person and sort of walk them back through and help them to see, this is kind of where this market came from. And I think if you take the time to do that, you could really offer that person kind of an aha moment, oh, now I understand, why this is the way it is and where it came from. So I think it's mostly about that, kind of modeling, and then taking the time, to explain and to play devil's advocate a little
Yes.
bit, and to say, okay, well, you know, um, you're asserting this. Well, what might be the opposite? Kind of taking the opposite side of an argument, in an IC meeting, or in even in a more casual conversation about, kind of the business or the market. So I think those are all ways, that you can do it. But I think it's about taking the time. I think another thing, um, that's helpful is, and this is one of the things that I think sometimes gets a little bit lost, particularly with folks who are focused on getting to the answer as quickly as possible,
Yes.
but attention to detail.
Mm-hmm.
Like, it really matters what the loan agreement says. It really matters what a bond indenture says about, collateral, or, things of that nature, the structure of a transaction, and why it's important to take the time to read that document, as opposed to, let me just kind of get to the right answer and draw a box around it, and helping them to see, what can go wrong if that level of attention to detail isn't there in their process. I feel like there's a tendency in this very data driven environment to kind of focus, at a macro level, right? So I looked at 10 comps, and this was the leverage and this was the coverage, and, here's where they trade. And I pulled down all this data, and, look, it's really nice. But, did you read the collateral sharing provision? Things of that nature.
And do you find these folks are receptive to that sort of guidance?
If you take the time to explain why, yes. If you don't take the time to explain why, then I think not. So it's just going to add a little time to your day. And I think that's a big thing. You have to be willing to do that. And if you're not willing to do that, then, maybe, that's not the right role for you.
Fair enough. Yeah.
Maybe you shouldn't be managing, maybe you should focus on doing. And, so that's something you have to kind of resolve for yourself. If you're kind of unwilling to do that, then, and I think that has happened in our industry, probably, unfortunately, maybe more often than is necessary.
That's fair. A lot of highly successful, maybe low patience folks out there who just want to get to the right answer versus letting people make their own mistakes and then taking them through how to get to the right answer.
Yeah, that's well said.
Yeah.
That's well said.
So on a more fun topic, I read recently in the journal, this must have been the last 6 months, that people are putting their golf handicaps on their resumes, and it's a huge booster for careers in financial services. Do you find that to be true?
I don't know. I haven't seen that yet. I'd be a little leery because, of course, to get that handicap that we'd all love to have, it does require quite a lot of time. I think that the way I think about it is that business in general and finance in particular, I mean, it's a social activity.
For sure.
Right? So business in general is a social activity, especially the way that the economy in this country has evolved. Business is a social activity. The finance is the most social because it's all dependent on contractual relationships, right, between parties. So it is the most social of the business disciplines. And so anything that promotes that, kind of sociability is a good thing. So perhaps it's golf, perhaps it's some other sport, but some other activity that promotes, kind of social interaction and enhances social skill. I think it's certainly a competitive game. I'm not very competitive when I play it, as you know, but so it satisfies that desire to be competitive, but in a way that's very fun too. But I think it's about so yeah, I would encourage. I think any resume that shows up in our inbox at Nassau Global Credit that doesn't, have some outside interests, particularly things that are sort of shared or social, that's to me a minus. So it doesn't have to be golf. It could be anything, but I think things that are, kind of based on social interaction, certainly sport. I think the other thing that I've noticed about finance people, maybe particularly since COVID, is a stronger emphasis, certainly from when we were coming up in the business, Steve, on health.
Yes.
People are much more focused on kind of their health, and, maintaining, physical health, mental health. And so having an outlet, whether it's golf or, whatever it may be, I think, is also seen as a positive. This is someone who, cares enough to kind of, if their hobby is, I don't know, Excel or something, that's not a good hobby, right?
Right.
But if you mention golf or something else particularly, something where you're interacting with other people, I think that's a positive. I won't put my golf handicap on my resume. Probably never.
Me either. It's a little too gaudy to put on a resume. Yeah, that's right. I always think of D1 golfers being great for the sales desks at banks, right? People really want them there, but hopefully it hasn't infiltrated too far given the erratic state of my game, as you well know. So finally, can you talk about 1 or 2, 3 pieces of advice you've gotten for your career that you've kept with you and feel are meaningful?
Yeah, I mean, I think a few things. I had one of my bosses years ago gave me a pillow, and embroidered on it, it says, "The harder I work, the luckier I
Ah,
get."
yes.
And this is like the kind of thing your boss would give you, right? But I've kept it over the years because I do think it's true. Luck plays a role, and it's important to acknowledge the role that luck plays. Whether it's day-to-day trading in the market, whether it's career moves more broadly, luck plays a role, and it's helpful to acknowledge that. But you can manufacture, some of your own luck.
Yeah.
And hard work is I think where luck comes from. I think the other thing, and I learned this early on in my own career, you know, change is a constant,
Mm-hmm.
and you have to be able to pivot, to adapt, to adjust and respond in real time, course correct if that's what it takes. But it's critical. I was working at a bank that was subject to a big merger, and I remember thinking, well, this was in the early days of big bank consolidation, relatively early on, and thinking, oh well, this will be an interesting once in a lifetime experience.
Mm.
Well, there were two more
Right.
major mergers that happened there, so new people, new processes, ways of doing things. You may have a valued colleague, a mentor, perhaps, and that person goes and does something else. That's natural. That's going to happen. So
Sure.
being able to adapt, I think, is the second thing. And then I think, it's like a little bit cliched, but it's something that I've carried with me, which is, Albert Hubbard's essay, "A Message to Garcia," right, about initiative, responsibility, authenticity, consistency, dependability. And I would, I would think that any young person starting a career, you could look it up on AI. You don't have to read the whole thing. AI will summarize it for you.
Right. That's right.
But Albert Hubbard's essay, "A Message to Garcia," maybe it's having another moment. It was, President McKinley, and, he's sort of come back into vogue lately. So I would say those are a few of the things that I've sort of carried with me.
Excellent. Well, that's all the time we have for today. Jonathan, thank you for making time and your ongoing friendship, which we very much appreciate. I hope our listeners learned as much as I did.
Thanks, Stephen.
Excellent.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.